Hello and welcome to Erik Bank. My name is Jonas Thulin. I'm head of asset management. And I'm going to walk through our global outlook for markets, trends, etc., etc. I'm skipping the conclusions because they're in Swedish, so I will try to verbally quickly go through what we're talking about. The debt ceiling obviously being resolved for now. What we're now tracking is that, yes, the US Treasury has to refinance itself, maybe $1.2 trillion. They're probably going to do 600 million this year. Will that suck money out of the banking reserves? We don't think so. Will it suck money out of the RRP facility? That's what we think. So. And therefore, the Fed will not be able to hike anymore this year, probably cut in order to make it more, sort of open up that regulatory arbitrage capability between the RRP program and the two-year Treasury bill, basically. So the question for us right now is not so much the debt ceiling, it's more how you're going to finance the gap in the US Treasury. And we believe that banking reserves is bad for equities, if that's what's going to channel the liquidity, or if you're going to have a lessened use of the RRP, reverse repo program, that came in after the pandemic, that will be positive for the equity market. Now we look at political risk. We see it's going to fall over and roll down, and we can measure political risk just by looking at order data in politically sensitive sectors, and then forecast like official US political risk and conflict indices. And we think we are seeing the peak of this year, and it's actually going to roll lower. This could impact equities positively. It might not, but at least it's something positive to keep in your pocket as well. Now, we've been speaking about this graph for since Q3 last year. We still believe that we're going to move from a low growth, high inflation to a low growth, normal inflation. The delta in the equity market since the 1970s is at plus 25 percentage points. And I think this is what people have missed, that we've been focusing since June last year on trading the inflationary outlook. Inflation peak, equity market trough, and everything's been working out, generally speaking, quite well since then. Our trough in our global equity and Swedish equity portfolios was in June last year, actually. And some of our global equity, our sustainable global equity portfolio right now has actually closed the entire drawdown from 2022. So it's quite interesting to see the speed of the reversal. And our thesis has always been that you're going to have a rebound, it's going to be in equities. You cannot afford to unweight equities, especially if yields are performing equally as bad. And I will come back to that. Right now, if you contrast a 60-40 to a 40-60 portfolio, as you see in the blue time series here, we have no reason whatsoever to underweight equities for the time being. We are maximum overweight equities, and we have been since June last year. Our risk model is indicating, in beige, is indicating prolonged risk. So how on earth have we been keeping maximum overweight? Because as we remember, global equity markets had a tough September. We had a tough September as well last year, but not as tough as the global benchmark. And this is sort of one of the core of our reasoning, that with a global mandate, with global yields and global equities, or global rates I should say, the maximum drawdown since the 1st of 1st, 2020 has been almost the same. In terms of performance, you have been way better off just to keep all your cash or your money in equities compared to rates. From a risk-adjusted point of view, the same result. So equity has been the utmost winner. And I think this is what is quite easily forgotten when people are nervous or concerned about equity markets. So what's your alternative? Can you put in cash? Well, that's another thing. Can you use alternatives as we can? We almost double-digit growth last year. Then you can afford to carry cash or afford to carry equities. Because the thesis has always been that the rebound days are so aggressive in these markets that you cannot afford not to be in equity markets. And if you look at this graph from JP Morgan and Bloomberg, you can see that by just missing the 10 best days for the last 20 years cost you half of your return for that 20-year period. So 10 days contra 20 years, almost a bit rude from the equity market. But these upside momentum, the upside swings that we've seen in our portfolios by being maximum overweight, being very long US tech and AI, etc., has really transformed 2023 to one of the best years we've had so far. And I think the trick is just to be able to sustain and live with equities, especially when rates are performing as bad as they have. So should we sell in May and walk away? No, absolutely not. There's to me at least, there are no statistical reasons for that. You can actually see that with a US mandate, you're way better off, some 40% better off, by just keeping your long positions. There's a case to be made in Europe if you keep the strategy long enough to cover European banking crisis that happens during the summer. But I think that's a bit too negative scenario to play with. So we keep our maximum weights going into the summer and have no plans to sort of take it down. Not this week, but the week after, we're going to have CPI in the US. We're going to fall a full percentage point in the headline. We think this is probably anticipated by the market, but what's not anticipated by the market is that the trajectory is just going to keep on going more and more aggressive on the downside. And there are a number of reasons for that. To the left-hand side is showing the arithmetic situation that we do not have a month-on-month move that's big enough to threaten this fall off in the CPI. Remember that 5-year neutral CPI is still by 2.5 percentage points. We increased risk where I signed there a little circle where you have the maximum of the common inflation expectation measurement from the Fed, because we think that maximum was the peak. So far, we keep our strategic weight since then. We shift in our tactical positioning, but we haven't changed or pushed down or pushed up equities for that matter. Just keep on being maximum weight since then. And compared to rates, that has definitely been the better call. Compared to index and benchmark, that's also been the better call, especially after this year's strong start. Now, also working on this is the owner's equivalent rent, or the shelter component, as you know. I mean, that's house pricing, rents, rates, and insurance costs. And we know that some 70% of the CPI move has, or the contribution of it on the upside is from the owner's equivalent rent, even though it's only 40% of the actual CPI basket. We think it's going to roll over. There are a number of reasons why there's a lagging effect of this, given the fact that it affects budgets and substitution effects from housing programs and social aid, etc., etc. So it's a good reason for it to lag, but the idea here is that it's going to fall over quite rapidly. It's going to push the CPI level aggressively lower in our mind. Also speaking for this is supply bottlenecks that are almost pushing the US into a deflationary scenario. Deflation is not uncommon in the global economy. China is exporting deflation to the US for the time being. So this entire move is quite interesting, given going back to the RRP facility, which you're probably aware of, that you're getting paid to push your cash in the Fed through the RRP by you take 5 basis points and you add it on the lower bound on the Fed reserve rate. So obviously, if the 2 years is not competing with that rate, you can't channel money from the RRP program out to the 2 year, which you want people to do, because that's where you can finance the US Treasury. So it's almost a cent now for the Fed to help by saying we're going to skip the hiking in June. I believe they were going to skip the July as well in order to push down and anticipate lower. And obviously, with inflation data confirming this, it could be a really great timing from the Fed, actually. It'd be really interesting to follow. Sticky? No. Wage growth falling over as most other years. Yes, you can find small data prints. They show some stickiness, but then again, they're always sticky. They're always going to roll over with the headline. Headline inflation leads wage growth, not the other way around, etc., etc. So it's all rolling over now quite neatly. China, as I said, exporting deflation, as you can contrast here by looking at the Chinese CPI PPI spread. Wage growth in the US, given a number of variables, also turning lower. If you look at the Mr. and Mrs. Smith on the street in the US, where is inflation going to be in 1 year time? They're going to answer 1.5%. We think that's way low. But it's interesting that in terms of the US consumer, they do not see inflation that much higher than 1.5%. If it's going to be true or not, we have to wait and see. But clearly the trend is quite rapidly on the downside, which is why the market has been trading on this since June last year. We've been doing this for a year now. European inflation is going to roll over as well. I'll come back to Swedish, but we're obviously lagging, but the trend is still the same. All this means, that the Fed is going to stick to the guns, and the market has always been anticipating that this hiking cycle will end up with a dramatic cutting cycle. And the left-hand graph here is where we were before the first hike in March 2022, and the right-hand graph is where we are today, and clearly you can see that yes, we moved rates higher than we first thought, but the trend is still there. You're going to end up with massive cuts. And the reason for that is obviously that the inflation is falling over much more rapidly than economists anticipate. And if you contrast this hiking cycle to other hiking cycles, you can see here in dark blue, this is the first time we hike central bank rates aggressively whilst inflation is falling as much as has been falling. That's also putting this hiking cycle in great contrast to all other hiking cycles, which is why we also think that the dollar move is a bit hollow. So we spread our currency exposure in the global equity portfolio from predominantly being a dollar position that we had following the war, etc., to right now the dollar is about 40% of the portfolio. And that was been a good call because the euro is giving us more value this year, and the sterling has definitely given us more value this year. And the remainder, some 15-20%, is in Swedish krona. So there's might be something neatly going on here. On a nerd level, I look at artificial intelligence, which has been a great trade for us, as you can see, it's spiking up in gray. And we can front run this by looking at where is the Fed's going to be what's the price delta in Fed rates in 2 years' time, which I show you in the bottom left-hand graph. Inflation outlook, top right-hand graph, or consumer expectations of inflation. And you can see there quite clearly that the AI strategy is pretty much playing catch up with the underlying inflation pressure and the future pressure from the Fed, which has sort of been the idea from the beginning. This time it worked great, next time it probably might not work great at all, but it has great spillover effects into Korea, even India, etc., etc. That has sort of been the tail of positions that we've been putting on the last couple of weeks. The peak hawkishness from the Fed was in June last year. We can measure that by natural language programming on looking at the talk and how they use wording. And clearly that was the trough of the equity market and the peak in the yields that we were able to create. And that's a trade that we keep on running. So for us, the pivot with the actual move is pretty much unimportant. The real pivot was the language when it switched from pushing the hawkish scenario to be neutral and then more and more dovish. And the price momentum in the market that peaked in October in terms, you remember back in October was 75 basis points, and all of a sudden it was maybe 50, maybe 25. And that was sort of the peak hawkishness in terms of the Fed pricing. And that was great buying signals for the equity market. And all this means obviously that we're sticking now to our guns in terms of being long US treasuries from 4.2 percentage points. We also have a curve steepener on. On the right-hand side, you can see that this trade has been good and bad and good and bad. Right now, we're sort of in a bit relatively bad move, given the depth seeding, but we're going to stick to it. Underlying all this, which I think is also quite neat, is if you look at the delta momentum in global central banks, you have to remember that globally, the peak hawkish move was in August 2022. Again, a great reason why the business cycle rebounded, a great reason why the equity market rebounded. But in terms of hiking versus cutting, it's quite interesting to see that the momentum is sort of disappearing now from the hiking scenario and the hawks more to the neutral or even the doves. On top of this, we have to through the banking crisis. You can see the programs on the left-hand side. You can see the effect on financial risks on the right-hand side. That the financial risk is now falling. You see financial conditions improving. If you look at financial stress, it's we had a blowout after the banking crisis. On the Monday is the highest orange pillar. On the Tuesday when we saw it bite, we bought artificial intelligence. On the Thursday we added, with the idea that the programs are a lot faster, a lot bigger than was first anticipated by the market. Hence the financial crisis will be calmed and disappear quite rapidly. That has fortunately happened this time around. What about the longer term effects? Well, I think the situation becomes a bit more complex there. If you look at the senior loan officers survey, for example, you can become very scary graph, as I show here on the right-hand side. But that's just the banking side of things. If you look at the people actually using the liquidity, you have the NACM survey, which I show on the left-hand side. You can show sort of a neutral reading so far in terms of the banking crisis. Because obviously, we all knew that the banking lending is going to contract and go down negatively because that's already been priced given the fact that we raised rates so aggressively in 2022. As I show you here, this is how much of the equity market has been pricing in a sort of not a recessionary, but a negative growth in terms of bank lending. So we all knew this. And on top of this, you have to contrast the senior loan officers survey with private debt or private lending. So the credit impulse indicator in the US, the red, is still positive. The senior loan officer survey, dark blue, is sharply negative. The wedge in between there is private lending. and a number of other reasons, but predominantly private lending. The problem with private lending is that we don't really have good data on it. We have a number of data sources that we use to make this analysis, but not strong enough. This is why we are focusing on this analysis and as a sort of a key risk in our very constructive and positive view. Globally, in terms of Centix and global credit momentum is still positive. So what does this all mean for the recession then, or recession risks? Well, put it a bit weirdly, right now, if we're going to follow our recession monitor in the US, we should go up and say there's 0% chance of US recession. Now, we've been working with this model since a couple of decades, so we know that data can be revised, so we're a bit careful on this. But it's interesting to see that in terms of recession, we don't think there's a chance of US recession. There's a small chance for a soft landing, but actually the no landing camp has econometrically been supported by the last couple of months' developments. So we can see industrial production should tilt down a bit on the negative side, bank lending should be negative, but that's already been priced. And I think the momentum right now is to be caught on the upside and see these kind of sharp moves that we've seen in terms of the recession risk, which is obviously why the market also became quite prone to buy equities, because we can all see the recession risk is falling quite rapidly. Globally, we're still in this rebound case, and I think this is what people have missed quite a lot. This all means that you have to revise up our GDP estimates. On the right-hand graph here, we show the US being revised up, Europe being revised up, Sweden, not so much, but we're going to catch up. So as long as we're in this upward revision, it's quite tough to be negative on the equity market, because that means that you already priced way too much in the pessimism, and that has to be reversed. So we think the equity market has more legs going into this year. And we measure daily US GDP growth on the left-hand side there. If you look at Sweden, we were in the Swedish recession camp. We left it. We are 10 times overweight Swedish equities compared to the global benchmark. We're going to stick to that because we do not no longer, since a couple of months back, believe that Sweden is going to end up in a recession. In fact, we believe the market will be surprised on the upside on Swedish development, and banks, etc., has to start to revise up their GDP forecasts. Quite interesting given the amount of beating the Swedish krona's had. So, going back to the US, this also means that we saw no risk of any state in the US now experience a slow momentum or negative growth. This is quite important, because if we were to end up in a US recession, some state, somewhere amongst the 51, has to show a deteriorating environment. They are not. So we believe that as long as this data confirms that there's simply no recession risk in the US, it will be a bit almost foolhardy to believe in a US recession and be short or underweight equities. This is the data calendar for the next couple of weeks. This is a soft week, focusing a lot more on bank reserves, RRP, for the US Treasury. The auctions are going to come up, and the data is really heating up next week with the CPI in the US. ECB will hike 25 basis points. US will skip that data meeting, push everything into July. We think they will actually skip July as well, and then they're going to come into the pause argument. And on top of this, Swedish inflation is going to roll over, GDP is going to pick up, etc., etc. The Swedish inflation I show you here quite aggressive on the downside through the new news here, but it's pretty interesting to look at the bank consensus in Sweden, which we think are way too lofty CPI numbers, way too high. This has to be changed. But fortunately, no one is trading on that really, so it won't affect any on the Swedish krona anymore. But it's quite interesting from more of an academic point of view, I guess. US retail sales were surprised on the upside. If you look at credit card usage on the right-hand side, you can see the softness in last number, but then you have the rebound again. So we believe that the market will be a bit surprised on the continuous momentum on this US retail side. Also, the production, as I showed in the soft landing graph, is going to come in a tad lower, and then it's going to start to rebound. So the trough here is really interesting to look at. When will you shift out in your rebound scenario to materials, etc., etc. We are front-running this a little bit with our commodity positions, but there probably is more to be done there going a couple of months down the line. So, I mean, in terms of Germany, I would strongly argue for that you should look at the right-hand graph in this one, which is the weekly updated GDP data that we get from the Bundesbank rather than the actual GDP prints. Why? Because this graph on the right-hand side actually leading the equity market. GDP, even though it's 2 quarters of negativity, GDP growth, I mean, no one really cares. This is the key graph for the the German economy, and we're keeping our long German positions in the equity market. Production here on the left-hand side, we actually think is going to surprise the market on the upside. In Sweden, we're still stuck in this environment where the retail sales is catastrophic. Remember, we were in a recession already in retail segment even before the first hike from the Riksbank. The debt service ratio in Sweden, as you can see in the dark time series on the right-hand side, is alarmingly high and fairly low in the US. So obviously the rate hikes have had a tremendously different effect on the Swedish economy compared to the US. Might be good for 5-10 years down the line if you look in how the Swedish real estate and apartment situation has been going. Rather being an ultra red and one of the most highly valued retail real estate markets, we're actually been falling off quite rapidly. I guess that it's good from a number of sense in terms of macro stability going into the future. So it might not all be bad, but here and now we have to remember that this has nothing to do with the equity market. Left-hand graph, I show the strength in the Swedish manufacturing versus the weakness in the Swedish retail. And if you translate this into a model for the equity market, which I do in the right-hand graph, you can see a sharp upside, i.e. the equity market is trading on the manufacturing cycle, also the low Swedish krona, not the weakness in the Swedish consumer, and that's quite important. In terms of the Swedish market, also do remember that in terms of financial liquidity, etc., Sweden is now very illiquid. In a dark green here, or dark brown, you can see how the financial stress is situated in Sweden. I think this has a lot to do with the fact that we've been regulating away a lot of liquidity, but it's also quite interesting to see that for us, Swedish mortgages or Swedish real estate or Swedish corporate bonds is something we are very careful about to invest in. We actually move a lot more into the European sphere. In terms of dollar, we think it's actually going to roll over into the second half. I look here at the net savings as a percentage of the US, or financial situation in the US as I called it. You can clearly see the downside move there in terms of the dollar. Will this get traction or not? We don't know. Since 1998, it's been a quite good model to anticipate larger moves in the currency. We're going to stick to this and forecast a lower dollar going into the second half. That is why we've been shifting out of our long dollar positions in favor of the euro, and that's been the right call so far this year at least, given that we made more money on euro SEK than on dollar SEK, also on sterling stock actually. In terms of positioning, we can also see the market is nibbling away into be positive, i.e. long euro dollar. Back in 2020, this created a 10% move in dollar SEK, so that would be it's quite interesting to anticipate this and be try to be ahead of the curve. Now we can be wrong on this, so we're also backing up a large proportion of the global equity portfolio in Swedish krona. If you look at the Swedish economy versus the US on the left-hand side, we can see that the dollar, or the spot, is clearly too weak compared to the relative macro environment. On the right-hand side, I look at the equity inflow in Sweden. Also, this is not a model, or it's more of a fun graph, if anything. But we can clearly see a downward push in dollar stock is there as well. On the equity outlook then, it means that we're still going to keep our maximum weight. We're going to keep our focusing on global equities, but we're going to shift away from just doing dollars. So we like Korea, for example. We think the Korean equity market hasn't priced in the Korean momentum in the economy. We like India still. We bought that in euros, not dollars or Korean won or rupee or anything else. But there's clearly upside momentum in Korea, obviously being helped by Samsung and the semiconductor sector. In terms of the equity sentiment and combined with flows, we're still in this bullish environment that we have been since last year. So there's really no reason to doubt the equity market. The equity market is going to test us time and time again. But if you look and just keep the cool head, I think that in terms of sentiment and flows, you can work tactically, but you should never underweight the equities in this environment. This is just a risk model showing that you're still very, very bullish on risk and is very pro equity markets going forward. But obviously the last couple of weeks in terms of debt ceiling, we have seen sort of the nitty-gritty spreads moving around. And now we capture this in our daily model. We can see, obviously you can see the banking crisis, or banking turmoil, and now you can see the debt momentum. So it's something they've been working with, but as long as it doesn't break any thresholds on the downside, we're going to keep our cool heads. And now we see the rebound from the solution of the debt ceiling. So all in all, we keep our positions as they are. On top of this, we can see the institutions buying, the smart money index is keep on climbing. On a valuation point of view, if you look at the PE adjusted for the current environment in terms of rates and the business cycle, we can actually also see buying signals. And on the right-hand graph here, in terms of Hui-Heubel liquidity ratio, we can also see that the market is a lot more stressed to participate in up days than stressed to avoid down days, which means that if you're already long as we are, this is great when there is sales, because we already know that the market is really stressed about missing updates a lot more than they're concerned about capturing or avoiding down days. Now on the left-hand graph, I show you in blue there that the asset managers from the institutional point of view is increasing the equity weights since last summer, and it's something we agree with, and we've done the same thing. Retail is another story, and speculative accounts, as I show you here in green, we also have to remember how they actually are trading the equity market. So that is a data series that we should be a bit careful about using. If we take a more holistic point of view, we have moved from a contraction environment in these 4 pillars since the 1948s. We've been allocating each sector and looking how they move depending on where we are in PMI. And as PMI has troughed, is working on the upside now in the US, we have left the contraction and moved into the rebound area. And there you can clearly see that yes, we should have information technology, we should have growth. We should also maybe look at consumer discretionaries and by the time maybe materials, etc. But definitely not healthcare and stuff like that. And that has sort of been our core since a while. That we're going to end this and try to front run it by keeping growth. Now, when do we know when to add or detract from growth? Well, we can try to anticipate value versus growth on a very broad level by this black indicator here. And blue is the actual performance. You can see now from the recent past, we've both had successes and adversary moments in terms of this, given the blue line has been skyrocketing in terms of value beating growth and then collapsing back again, and now it's collapsed and then some in advantage of growth. But the underlying model has always been convinced that you should be long growth. This has a lot to do with the production and manufacturing and total factor productivity that's developing in the US. And it's also a reason for us to, we always knew that if we were to underweight US tech, for example, you might make a short-term profit, but it's going to be very tough the day it's going to rebound. And I think the last couple of weeks has really shown and proven that, which is why we kept the tilt to the US tech, but working with derivatives on the overlay, so maybe we've been long some, short some. But now we since the last couple of months, we've been full on, fairly cleanly exposed to tech and those growth opportunities that are arising there. Now, importantly to us behind all this is this graph, which is really the key for our entire house view and our forecast. Earnings revisions and macro momentum troughed last June, and there's been a recovery. Add on the peak in inflation, add on peak hawkishness on a global scale from the global central banks. You have all the reasons in the world to be super long equities, and that's been our strategy. And I think we were fairly okay rewarded 2022, but really I think the big reward has been in 2023. So we're going to see how long we're going to stick to this, but for the time being, for sure, we're just going to keep on, but also then on the nerdy level, looking at how are you using bank reserves and facility, the RP facility. So if we also try to look at what I mentioned there quickly before, because stuff is happening in US productivity side. So if you look at it from a marginal factor productivity or total factor productivity perspective, i.e. how much more efficient do we become as workers? If you take those calculations, add on top the now cost calculations and some old school indicators in terms of profit forecast, but we only look at those profit forecast makers that are paid according to how good their forecasts are. We can get up with this blue line bars, I should say, and then you have the equity market. And you can really see that for the time being, we are in the most bullish environment we've seen for a couple of years, if I draw this back. Sometimes we get great traction on this, sometimes not, sometimes it leads less. But I think what's interesting here now is not just earnings revisions that were sort of bombed out and therefore they can only go one way, or some obscure global momentum in global GDP. This is actually also relevant from a factor productivity and profitability in the US corporates. So we are a little bit less concerned about zombie companies than others perhaps, as long as we can find this data. And obviously we can also isolate the TFP, MFP factor and look at versus the equity market. It looks great. And it's very hard to get a sustained downward shift in the equity market unless you have a war or something like that, of course, or pandemic, unless the productivity shifts with you. So this is something that we also want to leave some thoughts for you. This is really positive for the equity market going forward. Now, all these views are also summarized in a one-pager, so we were happy to send that through. Just give us a call. So that's all from me for the next couple of weeks, and then we're going to do one more small show like this before we make a break for the summer. Then we're going to be back in August, and obviously going to be back in the meantime if something dramatic happens in the market. But with that said, I want to thank you so much for your attention, and I'll be back in a couple of weeks' time. Thank you.